How are dividends taxed in Canada? Understanding how dividends are taxed in Canada and the tax advantages available for Canadian dividends can help you maximize your returns and make the most of your hard-earned money. To incentivize investment into Canadian companies, Canadian dividends get preferential tax treatment and are taxed much more favorably than employment and interest income. That's how investors make so much money compared to the working employee. In this video, we'll look at how dividends are taxed in Canada, the tax benefits of Canadian dividends, the impact of US dividends, and how to optimize your investment strategy to reduce the tax you pay. So let's start off with, what is a dividend? A dividend is a payment to a shareholder from a company's earnings. When a company is profitable, it can choose to distribute those profits in the form of a cash payment known as a dividend. Dividends provide a source of income from holding the stock alongside its potential for increase in value. So how are dividends taxed in Canada? Canadian dividends fall into two categories: eligible dividends and non-eligible dividends. Eligible dividends are paid by large companies such as an RBC or a Bell. When the company pays you an eligible dividend, they've already paid a 38% tax on this to the taxman. So the money you receive has already been taxed on. Non-eligible dividends are paid by small or medium Canadian businesses. When the company pays you a non-eligible dividend, they've already paid a 9% tax on this to the taxman. So again, the money you receive has already been taxed on. Now, how much dividend tax do you pay? The way that eligible dividends are taxed is that they are first grossed up. The dividend payment you receive is increased by 38% and added to your income that is subject to tax. For example, you received $100 in eligible dividends. This number is multiplied by 1.38 and added to your taxable income and taxed at your marginal tax rate. Now you're going to ask, first, this money has already been taxed on, but now I'm being taxed on a higher 138 versus 100. How is that fair? That's where the dividend tax credit comes in. The dividend tax credit reduces the tax paid on this increased amount. The federal dividend tax credit is 15% of this grossed up amount. You also receive a provincial dividend tax credit. For Ontario, it's 10%. So let's continue with our example. You received $100 in eligible dividends. The grossed up amount is $138. You have taxable income of $70,000, so your combined federal plus provincial marginal tax rate is 30%. The tax you pay on $138 at your marginal tax rate is $41. This is before the dividend tax credit has been applied. Then from this $41, you minus off the federal dividend tax credit at 15% of $138, which is $21. Then you minus the Ontario dividend tax credit at 10% of $138, which is $14, to end up with a tax due of $6. So on $100 of eligible dividends, you paid $6 in taxes and kept $94. This equates to a 6% dividend tax rate. Now, if you had received an extra $100 of employment or interest income, you would pay $30 in taxes and keep only $70. It's what you keep after tax that matters. Hence, Canadian dividend income is taxed more favorably than employment or interest income. Non-eligible dividends are taxed identically, but with lower percentages across the board. The gross up is 15%, the federal dividend tax credit is 9%, and the Ontario dividend tax credit is 3%. The mechanics are identical. Non-eligible dividends still get preferential tax treatment, but to a lesser extent than eligible dividends. Non-eligible dividends are taxed more favorably than employment or interest income. Dividend tax rate cheat sheet. If you have made it this far, I'm going to give you a cheat sheet to make your life a lot easier. You can simply multiply the actual dividend you received by the dividend tax rates shown here to calculate the tax you would pay, skipping all the steps above. You don't need to figure out if you received an eligible or non-eligible dividend. The financial institution where you hold your investments will send you a T5 and specify the type of dividend and items to report on your tax return. Negative dividend tax rates. What does this mean? Now you see negative tax rates here for Canadian dividends. What does this mean? Now, if you have a low marginal tax rate of 20.05% and you receive $100 in eligible dividends, this will result in a reduction of $6.86 to your tax bill. This happens when your marginal tax rate is lower than the dividend tax credit rate. Because the dividend tax credit is non-refundable, this number can only be used to reduce your tax bill and cannot be refunded back to you in the form of cash. You can use this negative tax to offset the tax you pay on other sources of income. For example, retirees can make strategic RRSP withdrawals and use this negative tax to reduce your tax bill in retirement. Next up, we cover foreign dividends. Foreign dividends, including US dividends, do not get any favorable tax treatment. These are fully taxable at your marginal tax rate, identical to employment income. Foreign dividends are subject to a foreign tax, known as a withholding tax. Withholding tax is deducted before the dividend is paid to you. What ends up happening is that this dividend is taxed twice. First, you pay foreign withholding tax, and second, you pay Canadian tax. To provide relief from this double tax, the CRA allows you to claim a foreign tax credit. The federal foreign tax credit is 15% of the actual foreign dividend payment you received. When you receive a US dividend, a 15% US withholding tax has already been deducted and paid to the US government. You then get a 15% foreign tax credit, eliminating this double tax. Even after this US dividend gets taxed at your full marginal tax rate, incurring the highest form of tax. Unfortunately, the foreign tax credit is not available for US dividends in tax-sheltered accounts, even though US tax has been deducted. The only exception where you do not have to pay US withholding tax is if the dividend is received inside an RRSP and listed accounts. You also have to complete a US W-8BN form with your financial institution. Only in this circumstance do you not pay any US withholding tax. Sadly, US dividends inside a TFSA and listed accounts have the 15% US withholding tax deducted, and you cannot claim the foreign tax credit. If you intend to invest in US dividend stocks or ETFs, hold these inside an RRSP and not a TFSA to avoid paying any US tax. How to optimize your investment strategy to reduce the tax you pay. First, invest in Canadian dividend stocks to get preferential tax treatment. Second, remember that Canadian dividends are taxed more favorably than employment or interest income. Allocate your highest taxed investments in your tax-sheltered accounts and keep the favorably taxed Canadian dividend investments in regular accounts to minimize the tax you pay. Third, if you're in a low marginal tax rate, use the negative dividend tax rates to offset tax against other sources of income. If you intend to invest in US dividend stocks, hold these inside an RRSP and not a TFSA to avoid paying US tax. Thank you for watching.